All right, so ready to jump into another deep dive.
Absolutely. Let's do it.
Awesome. Today we're tackling how to get a leg up in the stock market,
Hmm.
but not by chasing all those fancy algorithms or insider tips.
Right.
We're going old school, tapping into the wisdom of a legend.
Yeah.
Peter Lynch, the guy who ran Fidelity's Magellan Fund and crushed it.
Yeah. He knows a thing or two.
He really does, and he shared all his secrets in his book, One Up on Wall Street.
A classic.
And get this. Lynch actually believes that everyday people, like us,
Right.
have an advantage
Oh, interesting.
over those Wall Street hotshots.
Really? I mean, I guess I can kind of see that.
Yeah.
Interesting.
So tell me more about that.
So this is where his idea of the dumb money advantage comes in.
The money.
Yeah.
Okay, I'm already intrigued.
It's not about being, like, unintelligent, of course.
Right.
Lynch's point is that we're the ones living in the real world,
Right.
interacting with businesses all the time.
Yeah.
Think about it. You're probably spotting those promising companies
Mm-hmm.
way before Wall Street even knows they exist, just by going about your day.
I see.
So, just living your life.
Right. So it's like if you're the first one to notice that the new coffee shop
Yeah,
on the corner is always jammed packed,
exactly.
maybe you're seeing a certain brand of shoes.
Yeah.
All of a sudden they're everywhere.
Did ever you look?
Lynch, he found winners this way too.
Well,
He saw how popular Dunkin' Donuts was getting just by, driving around,
noticing all the new spots.
seeing all the new franchises popping up everywhere.
Yeah, yeah.
Incredible.
Observational investing, that's what he called it, I think.
So we're talking about observational investing,
Yep.
turning your everyday life
Yeah.
into stock market insights.
Exactly.
Okay, so I want to know from you, what are some things that you might be noticing right now without even realizing that it could be valuable information?
So it's about paying attention to the stuff that really wins you over, right? The products, the services, the companies that are, maybe quietly expanding or even like shaking up an industry that you really know well. That's where that dumb money advantage all starts.
That is super empowering.
Yeah.
Okay, so Lynch doesn't stop there.
No, he does not.
He actually goes so far as to call Wall Street pros oxymorons
Wow.
in his book.
Yeah.
So tell me, what is he getting at there?
Well, he's playfully skeptical of Wall Street, and with good reason. I think he argues that professional investors, those guys, they get trapped by these institutional pressures
Okay.
that actually make them worse at picking stocks
Interesting.
than the average person.
Than you and me.
Exactly. Yeah.
So it's not that they're not smart,
Right.
but the system that they're working in, it's holding them back.
Exactly.
Yeah.
And he tells this great story about, these two CEOs playing golf together,
Okay.
and they've both got their pension funds managed by the same big bank, right? One CEO, his account's doing amazing. The other one's, kind of lagging behind.
Right.
Well, the CEO with the lower return, he's furious,
Of course.
threatening to pull his money out of the bank.
Yeah.
So you can see the pressure on those fund managers is intense.
Yeah.
They got to chase those short-term gains, even if it means missing out on bigger opportunities.
So instead of thinking outside the box,
Right.
they end up all chasing the same hot stock.
Yeah, the same handful of stocks as everyone else.
Yeah, I see.
So they're all kind of in this herd mentality.
Right, and that's where the dumb money advantage comes in.
Exactly.
Okay, but there's a big elephant in the room, right?
Yeah.
A lot of people think stocks are just way riskier than bonds.
For sure.
What does Lynch say about that?
Well, this is where Lynch really challenges what everyone thinks, the conventional wisdom.
Yeah.
He argues that stocks, over the long term, they've actually outperformed bonds historically.
Interesting.
He even uses RCA as an example.
RCA,
Yeah.
the classic blue chip stock.
Yeah, the safe stock.
Everyone thought that was safe.
Yeah, guess what?
What?
It barely budged in value for decades.
Oh, wow.
So even a quote-unquote safe bet might not be so safe after all.
Right, but that doesn't mean we just throw caution to the wind.
No, not at all.
Right.
There are risks with stocks, no doubt about it.
Yeah.
But Lynch's point is those risks can be mitigated,
Yeah. How so?
by making smarter choices,
Right.
really understanding the different types of stocks
Okay.
and what kind of growth to expect from each one.
So he kind of lays those out in the book.
He does. He breaks down stocks into 6 categories. Slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Wow, there's a whole world in there.
There is. It's fascinating.
That's amazing.
And understanding these categories, it helps you assess a company's potential, even manage your own expectations.
So we're not just throwing darts at a board here.
No, not at all.
There's a method.
Absolutely.
Okay, well, I think our listeners are ready to start spotting some winners.
Yeah.
Let's break down these categories.
Okay.
But hold on. Before we get into, the nitty-gritty
right.
of each category,
yeah.
I think we should talk about like what you're looking for in a stock. Like, what makes a company a Peter Lynch kind of winner?
Great point. You're right. We need to kind of understand his philosophy first.
Yes.
Before we can apply the categories.
Yes.
So what does Peter Lynch look for?
Yeah.
Well, he loves companies with dull names.
Dull names,
yes.
Really?
Yeah.
You're going to have to sell me on this one.
I know, it sounds kind of counterintuitive.
Yeah.
But think about it.
Okay.
A company with a really flashy name or like a super hyped product, often it gets way more attention than it deserves. Drives the price up artificially.
So it's all hype and no substance.
Sometimes, yeah.
Okay.
Lynch looks for those companies that are quietly doing their thing, generating solid profits without all the fanfare.
Yeah.
He actually found that often those boring, under-the-radar businesses, they have a much better chance of becoming those 10-bagger stocks.
10 baggers, the ones that increase tenfold in value.
Exactly.
Wow.
Yeah. So
okay, I am intrigued.
Yeah.
Tell me about one of those boring companies that surprised everyone.
He talks about Crown, Cork, and Seal.
Crown, Cork, and Seal.
Yeah.
Now, who gets excited about a company that makes bottle caps?
Not many people.
Not me.
But you know what?
What?
I bet their stock did pretty well.
Yeah, I bet it did.
Phenomenal performer.
Wow.
And that's Lynch's point. It's not about chasing the latest trend.
Yeah.
It's about finding those companies with a solid business,
Yoga.
good management,
Yeah.
and a history of quietly generating those profits.
All right, I'm starting to see the light here.
Good, good.
So how do we find these hidden gems?
Let's
I
do
mean,
that.
are we just wandering the aisles of the grocery store looking for inspiration?
Well, that's part of it, remember.
Yeah.
The dumb money advantage.
Right.
But Lynch also has a very specific research approach.
Okay.
He believes you need to develop a story for each company.
A story.
Yeah.
Like a fairy tale.
Not quite a fairy tale.
Okay.
But kind of.
Okay.
It's about understanding, their business model, how they make money, their competitive landscape, who they're up against, their future prospects, basically why you believe this company is going to succeed.
So we're not just looking at, numbers on a spreadsheet. It's about understanding the narrative behind the company.
Exactly.
Okay.
He encourages using those readily available resources like annual reports.
Yeah.
But, going a step further, visiting companies, talking to employees, even customers.
He actually did that.
Oh, yeah.
Wow.
He tells a great story about La Quinta Motels.
La Quinta?
Yeah, he was really intrigued by their business model.
What was it?
They offer that Holiday Inn quality at a lower price.
Okay.
So what'd he do?
What?
He stayed at a bunch of their motels.
Wow.
Tested the beds, checked out the amenities, talked to staff, even guests.
So he was like a secret shopper for his own portfolio?
Yeah, you could say that.
That's amazing.
He wanted to see if the story lived up to the hype,
Yeah.
And it did. His firsthand research, it confirmed his impressions.
Yeah.
And the stock went on to be a huge winner for him.
I love that.
Yeah.
It's like detective work.
It is.
But for stocks.
For stocks.
But let's be honest, a lot of us, we get intimidated by those financial metrics.
Of course.
How do we make sense of those numbers without needing an MBA?
Well, Lynch makes it surprisingly easy.
Okay, good.
He focuses on a few key numbers that anyone can understand.
Okay, so give us the cheat sheet.
All right, so one of the most important is the PE ratio.
PE ratio, I've heard of that, but I'll admit I don't always know what to make of it.
Well, Lynch has a simple rule.
Okay.
A fairly priced company's PE ratio should roughly equal its earnings growth rate.
Okay.
So if a company's growing at, let's say, 15% a year, its PE ratio should ideally be around 15.
Okay.
So if you see a company, tons of growth potential,
right,
but a PE ratio that's, way out of whack, that could be a warning sign.
That's a red flag.
Yeah.
Okay, that's actually pretty straightforward.
It is, yeah.
What else should we be looking at?
Well, debt is crucial.
Okay.
Lynch likes those companies with low debt, especially in those uncertain economic times.
Right, because if the economy takes a hit,
Yeah.
a company with a lot of debt, that can be in real trouble.
Oh, absolutely, yeah.
Right.
A strong balance sheet is key, especially when things get a little rocky.
Makes sense. Less debt, less risk.
Exactly.
Okay, so debt, check.
Mm-hmm.
Anything else?
Well, cash flow. Lynch is adamant about this.
Okay.
Cash flow is a much better indicator of a company's financial health than reported earnings.
Yeah.
Remember how we talked about earnings being,
Sometimes misleading.
yeah, sometimes cash flow is harder to fudge.
Yeah.
It shows you that actual money coming in and going out of the business.
Right.
That's what you want to focus on.
It's the real deal.
It is.
Okay, so I'm starting to feel like I can actually do this.
Good.
But even if we find these amazing companies, how do we know when to sell?
Right.
That always seems to be the tricky part.
It is. That's where Lynch's experience really shines through.
Okay.
He has a clear approach to selling. And it starts with the company's story.
Right.
Remember how we talked about developing a narrative?
Yeah.
For each company?
Yeah, the whole detective work, figuring out why this is going to be a winner.
Exactly.
Yeah.
Well, if the story changes, it might be time to sell.
Okay.
If those initial reasons that you bought the stock, they no longer hold true, it could be a signal to move on, even if the stock has gone up in price.
Even if you're making money.
Yeah, even if you're making money.
Wow.
So even if you're making money, you need to be reassessing, making sure that story still holds up.
That's hard to do.
It can be.
Yeah.
It can be.
But it's important.
It is.
Right.
It is.
Okay, so we sell when the story changes or when we realize we made a mistake.
Yeah.
But what about those times when the whole market goes haywire? Like how do we ride out those ups and downs without losing our minds?
Well, that's where Lynch's long-term perspective is so crucial.
Okay.
He reminds us that those market declines are inevitable.
Right.
They're going to happen. It's just a matter of when.
Yeah.
He actually sees them as opportunities, not disasters.
Opportunities. How can a market crash be an opportunity?
Well, think about it this way.
Okay.
When the market dips, prices go down, right?
Yeah.
Which means you can buy great companies at a discount.
It's like a Black Friday sale for the stock market.
Yeah, when everyone else is panicking, that's when you can snag some amazing deals.
Wow. So it's about being brave when everyone else is running for the hills.
Yeah, pretty much.
But honestly, I'd be terrified to do that.
Sure.
How do you stay calm in those moments?
It all comes back to understanding those fundamentals.
Okay.
Trusting your research, having faith in those companies you believe in. And remember, those market fluctuations, they're normal.
Okay, so it's about resisting that urge to react emotionally and just make rational decisions based on that long-term outlook.
Exactly. And Lynch says trying to time the market is a fool's errand. You can't predict when it's going to go up or down.
Yeah.
And if you try to jump in and out at the perfect moment, you're more likely to miss out on those gains than you are to make a killing.
Okay, so if we can't time the market, what's the alternative?
Well,
is it just buy and hold forever?
Not necessarily forever, but Lynch is definitely a believer in long-term investing.
Okay.
Patient investors, they do their homework, stay the course. They consistently outperform those who try to time the market.
That's reassuring. I like that.
Yeah.
Okay, so I think our listeners are starting to get a feel for Lynch's approach, but there's so much more to unpack in this book.
Oh, absolutely.
We'll need to pick up where we left off in part 2 of our deep dive.
For sure.
Yeah.
We will.
Yeah.
Welcome back to our deep dive into Peter Lynch's One Up on Wall Street.
We're really getting into the meat of it now, how actually find those winning stocks.
Right.
Using Lynch's, his unique approach.
Exactly.
Last time we talked about how everyday investors, we have this kind of built-in advantage.
Yeah, that dumb money advantage.
Some money advantage.
Just by, living life, interacting with businesses.
Yeah, exactly.
Spotting trends before Wall Street even knows what's going on. Yeah.
And we started exploring Lynch's 6 categories of stocks.
Yes.
From, those slow and steady growers to the exciting fast growers that could be 10-baggers.
Right. But remember, it's not enough to just, slap a label on a company.
Right.
Lynch has some very specific advice
on
what to look for and what to avoid within each category.
Okay, so let's say we've got our eye on a company that, it seems to be growing like crazy. What are some red flags that might make even a fast grower a risky bet?
Well, Lynch points out that rapid growth,
Mm-hmm.
it can be a double-edged sword.
All right.
If a fast-growing company stumbles,
Yep.
even just a little bit,
Yeah.
the market tends to overreact,
Yeah.
and that stock can take a nosedive.
So it's not just about growth. It's about sustainable growth.
Right.
The
Exactly.
kind that can,
Weather a few storms.
Yeah.
Ride out the bumps in the road.
Exactly. What else should we be wary of?
Well, Lynch has this hilarious term
Okay.
for companies that make foolish acquisitions.
Uh-huh.
He calls them diversifications.
Diversifications. I love that.
It's great, right?
It's like they're actively trying to make things worse.
Yeah, exactly.
Yeah.
And it happens more often than you think. Yeah, a company gets flush with cash.
Mm-hmm.
They start feeling invincible.
Right.
And they go on a buying spree.
Oh, no.
Acquiring all these businesses that have nothing to do with what they're good at.
Right.
Their core competency.
Yeah.
Often overpaying in the process.
So it's like spreading themselves too thin
Yeah.
and losing focus on what they actually do well.
Exactly.
Yeah.
It's a classic case of,
Yeah.
like trying to do too much too soon.
Right.
A classic example is Gillette.
Gillette, the razor company.
Yeah, they were known for razors.
Mm.
A solid, profitable business, right?
Right.
But then they went on this crazy acquisition spree,
I know.
buying up everything from cosmetics companies to ballpoint pen manufacturers.
Right.
It was disaster. They diluted their focus, they confused customers,
Yeah.
and ultimately their stock suffered.
So it's a good reminder to
Stick to your knitting.
stick to your knitting.
If a company's branching out into areas that seem totally random,
Yeah.
that could be a red flag.
Okay. I like that.
Yeah.
So we talked about some things to avoid.
Mm-hmm.
Now let's flip the script.
Okay.
We know Lynch, he loves those companies with dull names.
Yes.
But what are some other things he actually looks for in a potential winner?
Well, we talked about how companies with boring names,
Yeah.
they can be overlooked by Wall Street,
Right.
giving you a chance to snag them before they really take off.
Right.
But Lynch also loves companies
Uh-huh.
that operate in no-growth industries.
No growth industries. That sounds not very exciting.
Not exciting.
Yeah.
But hear me out on this one.
Okay.
Lynch's point is that in a no-growth industry,
Mm-hmm.
there's less competition,
Okay.
less pressure to constantly innovate,
Yeah.
more opportunity for a well-managed company to just quietly dominate.
So it's like finding those niche markets
Yeah.
where the demand is steady
Exactly.
and there's not a lot of like disruption.
Right. Yeah. Less upheaval.
Yeah.
Think of something like funeral homes.
Funeral homes.
Yeah, not exactly glamorous,
Not really.
but the demand's pretty consistent.
That's true.
There's not a lot of technological,
Disruption happening there.
upheaval.
Right.
So,
Okay, I'm seeing the appeal now. You can kind of fly under the radar and just keep chugging along, making money.
exactly.
Yeah. Anything else Lynch looks for?
He's a fan of companies that buy back their own shares.
Okay, why is that a good sign?
Well, think about it this way.
Okay.
When a company buys back their own shares,
Mm-hmm.
they're basically saying, hey, we believe our stock is undervalued.
Oh,
Yeah.
yeah.
And we're willing to put our money where our mouth is.
Yeah.
It's a vote of confidence
Right.
from the people who know the business best.
That makes a lot of sense. They're essentially putting their money on themselves.
They are.
That's always a good sign.
Always a good sign.
Okay, so we've talked about some of those, qualitative factors
Right.
that Lynch considers. But of course, he doesn't ignore the numbers.
No.
We talked about the PE ratio last time.
Uh-huh.
But are there any other key metrics
Yeah,
that we should be paying attention to?
definitely.
Okay, yeah, give us the rundown of
Right.
what to look for when we're diving into those financial statements.
So debt is always a big one for Lynch.
Okay.
He prefers those companies with low debt levels,
Mm-hmm.
especially in those cyclical industries
Right.
that are more vulnerable to economic downturns.
Right, because if the economy takes a hit,
Yeah.
a company with tons of debt, they could be in real trouble.
Oh, absolutely.
Right.
Yeah, so a strong balance sheet
Mm-hmm.
is essential, especially when things get tough.
Okay, so debt, Check, check. What about cash flow?
Cash flow.
We touched on this before.
We did.
But why is it so important to Lynch?
Remember how we talked about earnings?
Yeah.
Sometimes being misleading.
Yeah, sometimes they are.
Yeah.
It's all smoke and mirrors.
It is, yeah.
Sometimes.
Cash flow is much harder to manipulate.
Right.
It's the real deal.
Right.
The actual cash coming in and out of the business.
It gives you a much more accurate picture of the financial health of the company.
Exactly.
You can see if they're actually generating cash.
Yes.
Not just, playing accounting games.
Exactly.
Right.
So Lynch wants to see companies that are consistently generating strong cash flow.
Okay.
That's a sign of a healthy business.
Right. All right. This is all starting to make sense.
Good. Good.
But where do we actually find all this information?
Right.
I mean, do we need to be financial wizards to decipher these reports?
No, you don't need a finance degree.
Okay, good.
Lynch encourages everyone to read annual reports.
Okay.
They're readily available on company websites or, through the SEC's Eddie JR database.
Right. I've seen those reports. They can be pretty intimidating.
They can be a little dense.
Yeah.
But Lynch gives us some guidance on what to focus on.
Okay.
He says to pay attention to the balance sheet,
okay,
the income statement, and the cash flow statement.
Okay. I know those are important.
Yeah.
But to be honest, I sometimes get them all mixed up.
Sure.
Can you give us a quick refresher?
Of course.
What each one actually tells us?
So the balance sheet, it's like a snapshot of the company's financial health.
Okay.
At a specific moment in time.
Okay.
It shows you their assets, what they own, their liabilities, what they owe,
right,
and shareholder equity. What's left over for the owners.
So it's like a financial checkup.
It is.
You can see if they have a strong foundation.
Exactly.
Okay.
Now, the income statement shows you how much money the company made, their revenue,
right,
and how much they spent their expenses over a specific period of time.
Okay.
So this gives you a picture of their profitability.
Right.
Are they actually making money?
Okay. And the cash flow statement?
So that one tracks the actual flow of cash in and out of the business.
Right.
It shows you where the money is coming from, where it's going, how much is left over at the end of the day.
Okay. That's a good breakdown.
Yeah.
I love that Lynch, he encourages us to dig into these reports.
Yeah.
But he doesn't stop there.
No, does he?
He does not.
He's a big believer in real world research too.
Yeah, he calls it kicking the tires.
Kicking the tires.
Yeah.
I like that.
It's a crucial part of his approach.
So if you're thinking about investing in a retail company, he says go visit their stores.
Okay.
See how the merchandise is displayed. Observe the customer service.
Yeah.
Chat with the employees.
So it's about getting a feel for the company culture.
It is.
Seeing how they treat their customers firsthand.
Exactly.
Okay.
And if it's a restaurant, try the food.
Try the food.
Yeah.
Okay. See if it lives up to the hype.
I like that.
He even suggests talking to the customers.
Really?
Getting their feedback.
Wow.
On the products and services.
That's brilliant.
Yeah.
It's about going beyond the numbers.
Yes.
And getting a real sense of the business.
It is.
You're almost like an investigative journalist.
Yeah.
For your own portfolio.
That's a great way to put it, yeah.
Right. And don't underestimate the power of talking to the company management.
Yeah, if you have the opportunity to attend like a shareholder meeting or, a conference call. Yeah.
Ask those thoughtful questions.
It's about engaging with the people who are actually running the show, getting a sense of their vision and their leadership.
Their leadership, exactly.
Okay. All of this sounds amazing. Yeah. But let's be real here. A lot of us, we don't have the time or the resources to do this level of, deep dive research on every single potential investment.
All right.
So what's a more realistic approach?
That's a great question.
Yeah.
For those of us with busy lives, well, Lynch suggests starting with companies that you already know and use.
Okay.
Think about the products and services you love, the ones you can't live without.
Right.
What companies are behind those?
So we're kind of leveraging our dumb money advantage.
Exactly.
Right. Yeah, we're using our everyday experiences as consumers to kind of guide our investment choices.
Exactly. You already have a built-in knowledge base.
You know what you like.
Right.
You have a sense of which companies are doing well, maybe in your local area.
Yeah.
You're probably noticing trends without even realizing it.
Okay, that's a great starting point.
Yeah.
But even with these familiar companies,
Yeah.
how do we go from, casually noticing them
Yeah.
to actually researching them
Right.
with an investor's eye?
Well, start with the basics.
Okay.
Check out their website.
Mm-hmm.
Read their annual report.
Okay.
See what the analysts are saying about them.
Okay, that's a good first step.
Yeah.
But how do we go from, gathering information to actually making a decision?
Right.
Like, what's the aha moment
Right.
when we know we've found a winner?
Remember how we talked about developing that story?
Yes.
Yeah.
Figuring out what makes this company tick.
Right.
Why we believe in their future.
Well, once you have that story,
Yeah.
you need to constantly reevaluate it. Okay, why is that?
Because businesses change.
Right.
Industries evolve.
Yeah.
And sometimes the story that made a company a great investment a year ago
Yeah.
might not be true anymore.
So it's about staying vigilant.
It is.
Right.
Yeah.
Keeping an eye on the company.
Yeah.
Making sure that that story's still unfolding the way we thought it would.
Exactly. And if the story changes, or if, the fundamentals of the business start to weaken,
Yeah.
that might be your cue to sell.
Okay, that makes sense, but selling can be just as tough
Well, it can be.
as buying.
Right. Absolutely.
Yeah. How do we know when to, let go of a stock?
Right.
Even if we've made a nice profit.
Well, selling can be tough, you're right.
Yeah.
But Lynch gives us some clear guidance on when to cut ties.
Okay.
One of his key principles is to sell when the story changes.
Okay, so we touched on that earlier.
Yeah.
But can you elaborate a bit?
Sure. It basically means if the reasons that you originally bought the stock, they no longer hold true,
Yeah.
it might be time to move on.
Okay.
Even if the stock has gone up in price.
Right.
So maybe the company, has lost its competitive edge. Maybe the industry landscape has shifted dramatically.
So you have to stay disciplined.
You do.
And avoid getting emotionally attached.
Yes.
Right. To your investments.
It's not about falling in love with the company.
Right.
It's about making smart decisions.
Right.
Based on the facts.
Exactly.
And Lynch also warns against this common trap.
What's that?
Of holding on to those losing stocks for too long.
Yeah.
Hoping they'll magically rebound.
Oh, I know that feeling.
Yeah, we've all been there.
Yeah, it's so hard to admit defeat.
It is.
And just cut your losses.
Yeah, it's tough. But sometimes it's the best thing to do.
Yeah.
Don't throw good money after bad.
Right.
Right.
Right, exactly.
Yeah.
So we sell when the story changes.
And we sell when we've made a mistake.
Yeah.
But what about when a stock's been performing well?
Right.
Like when do we sell a winner?
That's the million-dollar question, isn't it?
It is.
Lynch says there's no hard and fast rule.
Okay.
But he does offer some general guidelines.
Okay, I'm all ears.
Okay, so he suggests selling when a stock has become significantly overvalued, or when you found an even more promising opportunity,
right?
And you need to free up some cash, to invest in that.
So it's about constantly evaluating your holdings.
It is.
Right.
Yeah.
Making sure your money is still working as hard as it can be.
Exactly.
Okay.
And Lynch also emphasizes, not getting greedy.
Right.
If you've made a good profit on a stock,
yeah,
it's okay to take some chips off the table.
It's probably good advice for all of us.
It is.
Knowing when to walk away from the table while you're ahead.
Right. Exactly. But what about those times when, the entire market takes a dive?
Right.
How does Lynch approach those inevitable downturns?
Well, Lynch reminds us that those market declines, they're normal.
Okay.
They're a normal part of the investment cycle. They're going to happen.
Yeah.
It's just a matter of when.
Yeah.
And he sees them as opportunities, not disasters.
Opportunities.
Yeah.
How can a market crash be an opportunity?
Well, think about it this way.
Okay.
When the market takes a dip, prices go down.
Right.
Which means you can buy great companies at a discount.
It's like a Black Friday sale for stocks.
Exactly.
Yeah.
When everyone else is panicking.
Yeah.
That's when you can snag some amazing deals.
Okay, I can see the logic in that.
Yeah.
But it still seems scary.
Sure.
How do you stay calm in those moments?
It all comes back to focusing on those fundamentals.
Okay.
Trusting your research. Having faith in those companies you believe in.
Yeah.
And remember, those market fluctuations, they're normal.
So it's about resisting that urge to react emotionally.
Yeah.
Right.
Yeah, don't panic.
Yeah.
Just make rational decisions.
Right.
based on that long-term outlook.
Exactly, exactly. So Lynch says trying to time the market is futile.
It is.
You can't predict when it's going to go up or down.
You can't.
Right.
Right.
And if you try to jump in and out at the perfect moment, you're more likely to miss out on those big gains.
You are,
than to, make a killing.
Yeah.
So what's the alternative?
So Lynch advocates for staying invested through those ups and downs, focusing on finding those great companies, holding them for the long haul.
Okay.
Patient investors, they do their homework, stay the course.
Yeah.
They have consistently outperformed those who try to time the market.
Okay, that's a reassuring thought. I like that.
Yeah.
Okay, I think we've covered a ton of ground in this part of our deep dive.
Yeah.
But there's still more to explore.
Oh, absolutely.
We will need to continue our exploration of Lynch's wisdom.
We will.
In part 3. Welcome back, deep divers. We're wrapping up our exploration of Peter Lynch's one-up on Wall Street.
Yeah, it's been quite a journey,
It really has.
From harnessing that dumb money advantage to uncovering those hidden gems Wall Street often overlooks.
Right. We've even learned to appreciate the beauty of a dull name and the power of a no-growth industry.
Absolutely.
But before we send you off to conquer the stock market, Lynch has a few more nuggets of wisdom to share.
He does.
Specifically about the common mistakes that even smart investors make.
Yeah, we all make them.
So what are some of those pitfalls that we should be watching out for?
Well, one of the biggest ones is getting swept up in those short-term swings of the market.
Oh, yeah.
It's so easy to panic when you see your portfolio bouncing around.
Yeah.
Like a roller coaster,
Oh, tell me about it. My heart skips a beat every time I see a sudden drop.
Yeah.
Even if I know it's probably just a temporary blip.
That's exactly what Lynch warns against. If you're constantly reacting to every, little change in the market, you're likely to make those emotional decisions.
Right.
And that's rarely a good recipe for investing success.
No, it's not. So it's about staying focused on the long game.
Yes.
Not letting those daily fluctuations kind of derail your strategy.
Exactly. Lynch really emphasizes the importance of patience.
Yeah.
He reminds us that investing is a marathon, not a sprint.
Right.
He actually uses a brilliant analogy.
Okay.
He compares keeping tabs on a company you own stock in to playing like an endless hand of stud poker.
Poker.
Yeah.
Okay, I'm listening.
So think about it. You get dealt a hand. That's your initial investment.
Okay.
Then as the game goes on, you get new cards, new information about the company, new developments in the industry.
Yeah.
You have to constantly reevaluate your hand based on those new cards.
Okay.
And adjust your strategy.
So it's not a set it and forget it kind of thing.
No, not at all.
Gotta stay engaged, keep learning.
Yes.
Keep adapting as the game unfolds.
Precisely. And that leads us to another common mistake.
Okay.
Thinking you need to be right all the time.
Yeah.
To be a successful investor.
That's a lot of pressure.
It is, yeah.
I don't know anyone who's always right.
Right.
Especially when it comes to predicting the future.
Yeah, especially when it comes to the market.
Yeah, exactly.
Even the best investors, they make mistakes.
Right.
Nobody has a perfect track record. What separates the winners from the losers is their ability to learn from those mistakes.
Yeah.
And not let them, derail their long-term plan.
So it's about having a healthy tolerance for risk.
Yes.
Right. Knowing that you're gonna swing and miss sometimes.
Right.
But as long as you keep your eye on the prize, you stick to your strategy, you're gonna come out ahead in the end.
Exactly.
Yeah. Okay.
And there's another mistake that Lynch is especially passionate about warning against.
Okay. What's that?
Trying to time the market.
Ah, yes. That's like trying to catch lightning in a bottle.
It is.
It is.
Impossible.
Right.
Pretty much, yeah.
Right.
Nobody can consistently predict when the market's going to go up or down.
Right.
And if you're constantly trying to jump in and out at the perfect moment, you're more likely to miss out on those big gains than to make a killing.
So if we can't time the market, what's the alternative?
Yeah.
Just buy and hold forever.
Not necessarily forever.
Okay.
Lynch does advocate for holding on to those good companies for the long haul, but he also recognizes that that there are times when it makes sense to sell.
Right, right. Like we talked about earlier,
Yeah.
when the company's story changes.
Exactly.
Back when it becomes significantly overvalued.
Yeah.
Or when you find an even better opportunity and you need to free up some cash.
Exactly.
Yeah.
So it's about staying flexible, being willing to adapt, recognizing there's no one-size-fits-all approach.
Right, right. Okay, so we've covered some common traps.
Yeah.
Are there any other big mistakes that we should try to avoid?
Well, there's one more that Lynch highlights.
Okay.
Investing in companies you don't understand.
Oh, yeah.
It's easy to get caught up in the hype
Yeah.
and chase the latest hot stock, even if you have no clue what the company actually does.
Oh, I've definitely been guilty of that. It's like,
Yeah.
oh, everyone's talking about this company, so it must be a good investment.
Right.
Right.
But that's exactly the kind of thinking that Lynch warns against.
Yeah.
He says, stick to what,
Okay.
invest in those companies whose products or services you use and understand.
Yeah.
You're much more likely to spot those trends and opportunities
Yeah.
in industries that you're familiar with.
So it's another example of how that dumb money advantage
Yes.
can actually work in our favor.
Absolutely.
You know, we have this insider knowledge just by living our lives,
Yeah, just from our everyday experiences.
interacting with businesses.
Exactly.
Yeah. I like that. I think one of the most empowering takeaways from Lynch's book is that anyone can be a successful investor.
He really believes that.
Yeah.
You don't need to be a Wall Street insider. You don't need a fancy degree. You don't need a crystal ball.
You don't need to be a genius.
No.
Yeah, he really believes in the power
He does.
of the everyday investor, right?
He does. He believes that everyday people have this unique advantage because they're not bound by the same constraints and pressures
Right.
as those professional money managers.
Yeah, yeah, they can think independently.
Hey,
They can take risks. They can follow their instincts.
You can trust their gut.
Yeah,
Sure.
so it's about, trusting our own judgment,
Yeah.
doing our homework,
Yeah.
not being afraid to think outside the box.
Absolutely.
Yeah, and one of the things I admire most about Lynch
Yeah.
is his unwavering optimism.
He's very positive.
Yeah.
He truly believes in the future of the American economy and the potential for individual investors to succeed.
That's such a refreshing message,
It is.
especially in a world that often feels so uncertain.
It does. It
Yeah.
does. I agree. And he ends the book with this powerful reminder.
Okay.
He says, investing in stocks is an act of faith. You have to believe in the future of the company and the future of the country.
That's a beautiful way to put it.
It is.
It's about, having a positive outlook, believing in human ingenuity, and being willing to bet on the future.
It is. It is.
Yeah.
And if you do your homework, stay disciplined.
Yeah.
Keep that long-term perspective.
Right.
There's no reason why you can't achieve your financial goals.
Well said. I think that's a perfect note to wrap up our deep dive
I agree.
into Peter Lynch's One Up on Wall Street.
It's a great book.
It is. We've explored his key principles. We've debunked some common investing myths.
Yeah.
And hopefully given you some actionable advice to help you become a more confident and successful investor.
That's the goal.
Yeah, remember, this is just the beginning. The real journey starts when you take these insights
And start applying them.
put them into practice.
To your own investment decisions.
Absolutely.
So go out there, deep divers.
Yeah.
Put on your dumb money hats.
Yes.
And start hunting for those 10-baggers.
Have fun.
Until next time, happy investing.